This set of videos will take you behind some of the metrics you should be measuring in your business. We'll talk about what they are, what they really mean, and more. Today we're talking about the ins and outs of your accounts, payable and receivable, that is. Let's define our terms. Accounts payable includes any money that is owed by you to your vendors, while accounts receivable is any money owed to you by your customers. One of the most important elements of these areas is called turnover. In its simplest form, the accounts payable turnover ratio is a measurement of how quickly you're paying off your short-term debt to suppliers. It's calculated like this: total supplier purchases divided by average accounts payable. This matters because this calculation allows your investors, and you, to see how often you pay your average payable amount to your vendors. Along those same lines, your accounts receivable turnover ratio is calculated like this: net credit sales divided by average accounts receivable. A high receivable turnover ratio often means your collection policies are effective and efficient. A low ratio can tell you that you have poor collection process or are being too generous with your extensions of credit. If your accounts receivable turnover is low compared to your account payable turnover, it means you are paying your suppliers faster than your customers are paying you. This could create decreased cash flow. However, if your accounts receivable turnover is high compared to your accounts payable turnover, you might be seeing a cash influx. But it's important not to get spend happy, since you'll soon have accounts payable coming due. Accounts receivable and accounts payable and their respective turnover ratios tell a part of your company's story. By examining them and continually measuring them, you can see ways to adjust course, change methods, or improve systems to help your business succeed.